Let's talk about one of the most iconic names in investing, Berkshire Hathaway. If you've ever been interested in stocks, long-term investing, or building generational wealth, chances are you've come across this name. As of mid-2025, Berkshire Hathaway has officially crossed the $1 trillion mark in market capitalization, making it the largest financial company in the United States. That puts it ahead of legacy giants like JP Chase and Bank of America. No small feat. But with Warren Buffett, the legendary Oracle of Omaha, preparing to step down as CEO at the end of this year, many investors are asking a tough but necessary question. Is Berkshire still worth buying in a post-Buffett world? Let's dive deeper into why Berkshire became such a powerhouse, and whether the story is still worth betting on. Berkshire is built like a fortress. When we talk about diversification, Berkshire Hathaway is the gold standard. This isn't just a company that dabbles in a few sectors. It's a massive conglomerate with over 60 operating businesses under its umbrella. These include insurance, Geico, General Re, and Berkshire Hathaway Reinsurance; transportation, BNSF Railway, which alone generates nearly $25 billion in annual revenue; utilities and energy, Berkshire Hathaway Energy, a major player in renewable energy and infrastructure; manufacturing and retail, names like Duracell, Fruit of the Loom, and See's Candies; real estate and services, Berkshire Hathaway Home Services and other service-oriented businesses. Beyond that, it holds a massive stock portfolio, valued at over $350 billion as of Q1 2025. Its top holdings remain consistent and world-class. Apple, $145 billion stake. Bank of America, over $30 billion. Coca-Cola, held for more than 3 decades. American Express, another legacy holding with massive gains. This level of diversification gives Berkshire natural resilience. When one sector stumbles, say, tech or financials, others like energy, railroads, or manufacturing can step up. It's the equivalent of owning your own mini stock market index with built-in stability. A war chest bigger than most countries' GDP. Berkshire isn't just diversified, it's liquid. As of the latest quarterly report, the company sits on an estimated $350 billion in cash and short-term investments. To put that in perspective, that's more than the GDP of countries like Finland, Portugal, or New Zealand. Why does this matter? Because cash is opportunity. In times of recession, market panic, or rising interest rates, that cash becomes a strategic weapon. It allows Berkshire to scoop up distressed businesses at a discount, increase its ownership in top-performing companies, buy back its own shares at attractive valuations. Warren Buffett famously says, "Be fearful when others are greedy and greedy when others are fearful." With a $350 billion war chest, Berkshire can afford to live by that principle and profit from it. This flexibility was evident during the COVID-19 crash in 2020, and even more during the 2022 to 2023 market volatility. Berkshire consistently used down markets to strengthen its position. 3. A trillion-dollar bargain? Despite its size, Berkshire is surprisingly cheap. As of June 2025, its price-to-earnings (PE) ratio is around 13, compared to the S&P 500's average of 28. That means investors are paying less than half the multiple for every dollar of earnings Berkshire generates. Let's break that down. While other major corporations are priced for perfection, Berkshire is priced like a utility, steady, reliable, and even a bit boring. But in the best way possible. Its price-to-book (PB) ratio is around 1.5, also conservative given the quality of its assets and the value of its wholly owned businesses. For long-term investors, this presents a unique asymmetry, limited downside risk with meaningful upside potential. Older adult, what happens after Buffett? Warren Buffett, at 94 years old, has led Berkshire for over 6 decades. His calm, disciplined, and value-driven philosophy made Berkshire what it is today. But the transition won't be sudden or unplanned. Buffett has spent more than a decade preparing the company for this moment. His successor, Greg Abel, is no outsider. He currently oversees Berkshire's non-insurance operations, which account for the majority of the company's business activity. His leadership style mirrors Buffett's, quiet, focused, and execution-oriented. It's also important to note that Berkshire's structure is decentralized. Each business operates independently with its own CEO and strategy. Geico, BNSF, and Dairy Queen don't need daily oversight from headquarters. That decentralization is a major strength and helps ensure a smooth leadership transition. And Buffett isn't leaving Berkshire entirely. He'll remain involved as a board member and advisor, still a guiding hand, even if not at the helm. Personal take: why we are still bullish. Berkshire Hathaway isn't about short-term hype. It's about long-term wealth building. It owns quality businesses. It holds strong, conservative financials. It has a built-in succession plan, and it's undervalued relative to its potential. While many investors chase the next big thing, AI, crypto, speculative tech, Berkshire continues doing what it does best, compounding wealth through discipline and patience. It's not going to 10x overnight. But that's not the point. It's a cornerstone investment, a financial anchor for any serious portfolio. In a world of noise, volatility, and inflated valuations, Berkshire offers something rare: clarity and consistency. Let us know in the comments. Do you think Berkshire Hathaway is still a buy without Buffett? Or is its best era behind it? Like this video if you learned something, subscribe for more deep dive investing insights, and stay tuned for future breakdowns on the companies that shape our world.